Hello and welcome to Asset TV. Joining us now from Australia to discuss global infrastructure opportunities is Shane Hurst, Managing Director and Portfolio Manager at ClearBridge Investments. Shane, let's start with some definitions. In your view, what would you classify as infrastructure and what areas are you focused on?
Thanks, Jenna. And look, our definition of infrastructure is absolutely crucial for how we construct portfolios. What's important in terms of our universe is that we get the right type of stocks, the right type of assets into that universe. They need to be very stable return assets, low volatility of assets, but also that transparency of cash flow outcome going forward. So key areas we focus on in construction of our universe include utilities. These are your regulated water, gas and electric utilities. They're monopoly utilities, they're essential services. They tend to pass through in inflation and really tend to be mature dividend-paying utilities. The other area in terms of how we construct our universe is more GDP-sensitive companies and more GDP-sensitive assets, and they would include your toll roads, your airports, your rail and your port companies. Almost more important than what goes into our universe is what we exclude from our universe. And what you tend to see in indices, which we are index unaware, benchmark unaware, and it's important to differentiate that. So what we exclude from our universe are those companies that have a high volatility of cash flow. They would include your commodity-sensitive North American pipelines. They may include infrastructure contracting companies or infrastructure services companies that we don't see as core infrastructure.
And turning to security selection, what type of infrastructure assets are you looking for in your portfolios?
Yeah, look, we are looking for those very stable cash flow, as I mentioned before, stable return, low volatility type assets in our portfolio. Again, it depends on what part of the cycle we're in terms of the mix, but ultimately there are a number of key things that we look for. Firstly, we want attractive risk-adjusted return to equity coming from the companies that we invest in, the assets that we invest in. We need a very solid and measurable investment thesis, very solid and measurable catalysts with key milestones that we can track. And then ultimately, when it comes to understanding and including companies in our portfolio, we want a high level of sustainability, so ESG coming from the companies we invest in. Whether it's their policies or their practices, what's important is really their path over the next 3 to 5 years and whether they're actually improving or whether they're actually getting worse.
Yeah, I'm glad you mentioned ESG. How are you approaching ESG risks?
Yeah, look, ESG is absolutely crucial to our process. It's really holistic. It's incorporated into the way our analysts look at stocks every day. We are very proud of it. We've been a signatory to the UN PRI since 2010. We recently got upgraded to an A and an A plus for incorporation of sustainability and ESG into our process. We are very proud of that. And so we really have a 3-pillar approach to our investing in ESG and sustainability. The first is valuation. So where we can, we will aim to capture sustainability and ESG risks into our cash flows. And again, the reason for that is then we can sensitize that using our scenario risk analysis. That can be both positive and negative in terms of that incorporation. So a positive may be the increasing demand for renewables. A negative may be pipelines. So if you think about pipelines, the less gas and oil that's shipped through those pipelines over time, that will obviously have an impact on valuation. So our first pillar is valuation. Second pillar is risk pricing. So risk pricing involves us using our bespoke scorecard, which each analyst constructs. We then compare subsectors and each element of that sustainability scorecard with other comparable assets around the world. We then look at our companies and try to understand their sustainability profile going forward. Are they improvers or are they getting worse? And that's crucial to the way we incorporate that into our valuation. Ultimately, what we come up with is an adjustment to our hurdle rate, and that's that risk pricing component of the pillars. The third pillar, which really overarches everything, is engagement with management. A hallmark to the way we invest. We spend a lot of time doing very detailed infrastructure analysis, engaging with management, being very active in terms of the way we vote, active in the way we analyse controversies as it relates to assets and companies. And just to give you a couple of examples on how this will play out, a couple of years back, we were heavily engaged with Hydro One, a Canadian utility. We were very engaged with the reformation of their board. We had a number of meetings with the chairman, a number of meetings with the board members, so they could understand from an investor perspective what they should be doing when they reform the board to attract the greatest amount of investors and ultimately to run a successful listed infrastructure company. Another example is in Australia. So a regulated utility in Australia by the name of Spark Infrastructure, we've been engaged annually with their chairman. We spend a lot of time with their chairman helping to refine and improve the way they remunerate and compensate their senior management team. So summing up, ESG and sustainability is holistic. It's crucial to the way we analyse companies, and we've continued to evolve our process over the last 10 to 15 years.
And finally, Shane, I have to ask, how has COVID-19 impacted risks and opportunities within infrastructure?
Yeah, so look, obviously a very volatile period. The beauty of infrastructure and utilities is they are essential services. They're strategic assets, and ultimately there's very minimal to no impairment medium to longer term. That doesn't mean there wasn't some volatility in February, March, as we're all aware. So as we moved into that February, March period, I mentioned earlier our asset allocation. We were defensive moving into that period. Our team spent a good 2-3 weeks doing extremely detailed, what we call triage analysis on our portfolio and our universe, really understanding liquidity profiles, understanding dividend profiles, understanding some cash flow scenario analysis. We ran some very detailed cash flow scenario analysis with different assumptions, so stress testing those assumptions. And then we engaged with each of the management teams that we invest in, and then others which may be opportunities. And the reason we did that was so we could form, just back to our scenario analysis, that profile of upside and downside. And so through that period, we could identify points where companies would be attractive to buy, and in fact where companies would be good to or right to sell. And so as we came through that period, there were a number of areas where we found some opportunities, whether it be regulated utilities, which were in the US and Europe and in fact in Australia. These are essential service regulated monopoly utilities. They have inflation pass-throughs, very solid capex tailwinds, and actually very, very solid dividends and dividend growth. We found some great opportunities during that period in those regulated utilities. We also found some excellent opportunities in renewables and sustainable infrastructure. And through our process, we always are able to track those key milestones. But certainly over the last year and a half, we've been increasing that thematic within our portfolio. What you've seen in renewable infrastructure, whether it be solar, whether it be wind or battery tech, the cost of production has actually come right down. So they are almost competitive with your hydrocarbon type generation, your coal, your gas, etc. And so couple that with the big policy support that came out of Europe and some support that looks like it may come out of the US and certainly around the world, there were some great opportunities in that very volatile February, March period to actually increase our exposure to that key thematic. The final area was just taking a measured approach to investing in GDP-sensitive infrastructure assets. Obviously, during that period, people aren't flying, people aren't driving, goods aren't moving, and people are certainly concerned about the outlook for mobility around the world. They are often the best times to buy these assets, frankly, because they are long-term strategic assets. You know people are going to fly again. You know people are going to drive again down toll roads. So we took a very measured approach to how we invested in these GDP-sensitive companies. Our preference was with toll roads because we saw mobility improving first, then rail, and then airports.
Well, Shane, really great to have you. Thank you for your time.
Thank you very much.
And thank you for watching. That was Shane Hurst, Managing Director and Portfolio Manager at ClearBridge Investments. And I'm Jenna Dagenhart with Asset TV.